There's a woman in Tehran. Her name doesn't matter for now. What matters is what she did at 9:45 in the morning on February 28th, 2026, the exact moment the first American missile hit her city. She didn't run to a bank. She didn't call her husband. She opened an app on her phone and moved every rial she had into Bitcoin. Within minutes of those first strikes, before the smoke had cleared, before CNN had even confirmed what was happening, blockchain analytics firm Elliptic was watching something extraordinary on the network. Crypto outflows from Iran's largest exchange, Nobitex, had just spiked 700%. 700% in minutes. Not because people were speculating, not because some influencer tweeted a buy signal, but because 11 million ordinary Iranians had already learned, through years of hyperinflation, banking collapses, and sanctions, that when the system fails, Bitcoin doesn't. Now here's where the story gets interesting. While that was happening in Tehran, while ordinary people were racing to get their savings out of a collapsing financial system, Bitcoin's price on the global market dropped 4%, and every financial media outlet on the planet ran the same headline. Bitcoin crashes as war breaks out. Crypto is a risk asset, not a hedge. Digital gold is dead. They were watching the price. I'm going to show you something different. I'm going to show you the mechanics, the banking regulations, the monetary policy cycles, the shadow economy, and the institutional behavior that the headline writers either don't understand or don't want to explain. Because once you understand how this actually works, you will never read a geopolitical headline the same way again. Stay until chapter 4. Because what I'm going to show you there, a regulation almost nobody talks about, is the most important structural development in Bitcoin's entire history. Let's go. Let me start by explaining what you were actually watching when Bitcoin dropped on February 28th. Because it wasn't what you think. Here is a fact about financial markets that almost nobody explains clearly. When a major shock hits, a war, a banking crisis, a pandemic, prices move in two phases. Phase 1 is emotional. That's the crash. That's the 4% drop. That's the headlines. Phase 2 is rational. That's when the real money figures out what's actually happening. And that's when prices go back up. Bitcoin dropped to around $63,000 on Saturday night. By Monday evening, it was back above $67,000. That is not a crash. That is a dip and a full recovery in 72 hours. But here's what nobody explained. Why did it drop at all? Because the answer tells you everything about what's really happening in this market. When geopolitical shocks hit on weekends, and this one hit on a Saturday morning, institutional traders face a problem that most retail investors never think about. The New York Stock Exchange is closed on Saturday. The bond market is dark. Currency desks at major banks are running skeleton crews. But crypto? Crypto never sleeps. So what happens is this. A hedge fund manager gets the news at 9 in the morning on Saturday. He needs to rebalance. He needs to sell something to raise cash. His stock portfolio? Locked until Monday. His bond positions? Same. His only liquid market, the only place he can actually execute a trade in real time, is crypto. So he sells Bitcoin. Not because Bitcoin is bad, not because the thesis changed, but because Bitcoin is the only open ATM in the building. The Basel letter, one of the most followed market commentary accounts in the world, posted this in real time during the crisis. To everyone calling for World War III, Bitcoin is now positive on the day. Don't panic. They understood the mechanics. Now you do too. But here's what I want you to hold in your mind, because this is the first open loop of this video. If Bitcoin is being sold by institutional traders just because it's the only liquid market available on a Saturday, what happens when those same institutions go back to their normal desks on Monday morning? And what are they actually doing with that cash? We're going to answer that. But first, I need to show you something happening on the ground in Iran that changes the entire frame of this conversation. Before we dive into the data, I need you to drop a comment below and tell me exactly where you are watching this video from. Let me know your city, your local time, and what the weather is like outside your window right now. Maybe you are watching from London, where it is 10 o'clock in the morning and pouring rain outside. Or perhaps you are tuning in from Tokyo at midnight under clear skies, or even Sao Paulo at 8 in the evening with a warm breeze. I read every single comment, and it is always absolutely amazing to see this massive global community coming together. It reminds us that this market never sleeps, and that our network spans across all 24 time zones. Also, if you are new here and getting value from this content, please take 1 second to hit that subscribe button right now, leave a like on the video so the algorithm knows we are here, and let us get straight back to the breakdown. Let me introduce you to a country that has been living in Bitcoin's future for the last 6 years. Iran. Not by choice, by necessity. Here is the situation inside Iran right now. The Iranian rial has lost more than 96% of its value against the US dollar since 2018. 96%. In 2025, one of Iran's largest private banks, Ayanda Bank, went bankrupt. Over 42 million customers affected, $5 billion in losses, $3 billion in unresolved debt, gone. The Central Bank of Iran warned that over 8 local banks were at risk of dissolution. 8 banks. In that environment, when your currency is worth essentially nothing, when your banks are collapsing, when international sanctions have cut you off from the global financial system, what do you do with your money? You put it in the one thing that can't be inflated, can't be frozen, and can't be controlled by a government that has already failed you. Blockchain analytics firm. Chainalysis found that Iran's crypto ecosystem reached $7.78 billion in 2025, growing faster than the year before. The figure is larger than the entire GDP of some countries. The Maldives, Liechtenstein, several island nations. But here's where it gets truly extraordinary. Iran isn't just using Bitcoin as a savings account. Iran is manufacturing Bitcoin. Iran legalized crypto mining in 2019, and because the Iranian government subsidizes electricity at a rate of 0.5 cents per kilowatt hour, compared to 8.5 cents in the United States, the cost to mine one Bitcoin in Iran is approximately $1,320. $1,320. To mine an asset currently trading at $67,000. That is a 50 times return on production cost. The United States pays $75,000 to mine one Bitcoin. Russia pays $39,000. Iran pays $1,320. Iran has approximately 700,000 miners operating with 2,000 megawatts of capacity, producing roughly $1 billion in Bitcoin annually. Estimates put Iran's share of global Bitcoin mining power between 2 and 5% of the entire network. 1 out of every 25 blocks mined on the Bitcoin network may be mined in Iran, and it gets more complicated from there. Chainalysis estimates that addresses linked to the Islamic Revolutionary Guard Corps, the IRGC, accounted for more than 50% of total Iranian crypto inflows in the fourth quarter of 2025. Over $3 billion received by IRGC-linked addresses in 2025 alone. Elliptic also found that Iran's central bank accumulated at least $507 million in USDT 2025, likely to steady the rial and finance trade. This is a parallel financial system, built specifically to survive American sanctions. And here's the piece that almost no analyst is connecting. Every time the United States tightens sanctions, every time it cuts Iran off from SWIFT, seizes Iranian assets, pressures other countries to stop trading with Tehran, it is proving to every other country watching that the dollar-based financial system is a weapon, not a neutral infrastructure, a weapon. Russia watched what happened to Iran. China is watching what's happening now. Every nation that has ever been threatened with sanctions, which is most of the world, is asking the same question right now. What do we use when they come for us? And that question has only one censorship-resistant, politically neutral answer. But before we get there, I need to show you what's happening inside the world's biggest banks. Because there's a regulation, passed quietly, implemented almost without media coverage, that is creating one of the most powerful structural setups in Bitcoin's history. And most people have never heard of it. If you've made it this far, I need you to slow down with me for a minute, because this next section is the part that separates people who understand Bitcoin's long-term trajectory from people who are just watching the price go up and down. It involves something called Basel III. Basel III is the international framework that governs how much capital banks around the world must hold against different types of assets. It was developed by the Basel Committee on Banking Supervision. 28 central banks and regulators from the world's most powerful economies, coordinated through the Bank for International Settlements in Switzerland. Every major bank on the planet operates under these rules. Here is the risk weight assigned to different assets under Basel III. Cash and government bonds, 0% physical gold, 0% public equity, stocks, 300% Bitcoin, 1,250%. 1,250%. Let me make sure you understand what that number means in practice. If a bank wants to hold $1 million of Bitcoin on its balance sheet, it must set aside $12.5 million in approved capital reserves, $12.50 for every single dollar of Bitcoin. For gold, 0. For U.S. Treasury bonds, 0. For Bitcoin, 12.5 times the position size. Jeff Walton, the chief risk officer at Bitcoin treasury company Strive, put it plainly in February 2026. If the U.S. wants to be the crypto capital of the world, the banking regulations need to change. Risk is mispriced. Chris Perkins, president of CoinFund, described it as a very nuanced way of suppressing activity by making it so expensive for the bank to do those activities. The CEO of Strategy, the largest corporate Bitcoin treasury in the world, called publicly for reform. Now here's what most people miss when they hear this. Their instinct is, oh, banks can't hold Bitcoin. That's bad for Bitcoin. That is the surface reading. It is wrong. Here's what's actually happening. Institutional demand for Bitcoin is not going away just because banks face high capital costs. That demand goes around the banks, into ETFs, into treasury companies, into offshore vehicles, into private credit funds. BlackRock runs a Bitcoin ETF. Fidelity runs a Bitcoin ETF. Strategy holds 717,131 Bitcoin on its balance sheet. The demand exists. The regulated channel for banks to satisfy it is blocked. That creates a two-tiered market where institutional appetite is at an all-time high and the supply of regulated exposure instruments is artificially constrained. And now, this is the critical part that is starting to change. In November 2025, the Basel Committee met in Mexico City and officially agreed to expedite a review of targeted elements of its crypto standard. The chairman of the Basel Committee, Eric Tadayan, signaled that a different approach may be needed for the 1,250% risk weight. The implementation date for the full Basel III crypto standards was set for January 1st, 2026. Right now, those standards are in active review and reform discussions. Here is what the reform means if it happens. Every regulated bank on the planet, JP Morgan, Goldman Sachs, Deutsche Bank, HSBC, all of them, currently faces a prohibitive capital cost to hold Bitcoin. If that cost drops from 1,250% to something more reasonable, say 300%, matching equities, you unlock a wave of institutional capital that has never been able to enter this market under regulated conditions. We are not talking about retail investors. We are talking about the capital held by institutions that collectively manage tens of trillions of dollars. The war in Iran is accelerating this conversation politically, because the more geopolitical instability there is, the harder it becomes for Western governments to argue that Bitcoin is just a speculative toy, when Iran is using it to survive, when Russia is using it to circumvent sanctions. When 15 million Iranians depend on it for basic financial survival, the crypto is just gambling narrative becomes impossible to maintain. And that political pressure feeds directly into the Basel reform discussion. Now, I promised you at the beginning of this video that there was a macro thesis connecting all of this, a pattern that stretches back 40 years through every major Middle East conflict. This is where it gets uncomfortable, because the argument is counterintuitive, and it is made by someone with a very specific track record, which I'm going to be honest with you about. The year is 1990. Iraq has just invaded Kuwait. The United States is mobilizing the largest military coalition since World War II. Markets are panicking. At the Federal Open Market Committee, the group of central bank officials who set U.S. interest rates, the internal meeting notes from that period contain a phrase that is remarkable in hindsight. Members of the committee warned that heightened uncertainties stemming from events in the Middle East had, and I'm paraphrasing here, greatly complicated the formulation of effective monetary policy. Later that year, after the war began, the Federal Reserve cut interest rates. Fast forward 11 years, September 11th, 2001. Within days of the attacks, then Federal Reserve Chairman Alan Greenspan announced an emergency 50 basis point rate cut, citing, in his words, a heightened degree of fear and uncertainty. Emergency, 50 basis point cut within days. 2003, the invasion of Iraq. The Fed had already begun an extended period of monetary accommodation that would last years and contribute, many economists argue, directly to the housing bubble of 2008. Arthur Hayes, the co-founder of BitMEX, the former CEO of one of the world's largest crypto derivatives exchanges, and now the chief investment officer of Maelstrom Fund, published an essay on March 2nd, 2026, titled iOS Warfare. In it, he made the following argument. Every single major U.S. military engagement in the Middle East over the past 4 decades, the Gulf War, the global war on terror, the Iraq War, has ultimately ended the same way. With the Federal Reserve expanding money supply, either through interest rate cuts or through what we now call quantitative easing, the Fed buying assets to inject liquidity into the financial system. Hayes wrote, the longer Trump engages in the extremely costly activity of Iranian nation building, the higher the likelihood that the Fed lowers the price and increases the quantity of money to support Pax Americana's latest bout of Middle Eastern adventurism. His conclusion stated directly, and ultimately, BTC number goes up. Now, I need to be honest with you here because this channel doesn't do hype. Arthur Hayes has a documented track record of bold Bitcoin predictions. Some of them have been right, some have been wrong. He himself assessed his prediction success rate over 2023 and 2024 at approximately 25%, citing delayed market reactions as the primary factor. In December 2025, he predicted Bitcoin would reach $200,000 by March 2026. It has not. He is currently projecting Bitcoin between $500,000 and $750,000 by the end of 2026. Those projections are contingent on the Federal Reserve actually pivoting to monetary easing. As of this recording, the Fed has maintained a hawkish tone. The pivot has not happened. So why am I bringing Hayes into this video? Not because his price targets are reliable, they haven't been, but because his framework, the connection between war financing, Fed policy, and hard asset prices, is historically documented. And it doesn't require you to trust Hayes. It requires you to trust the 40 years of Federal Reserve meeting transcripts that he's citing. Wars are expensive. The US-Iran conflict, the continued support for Ukraine, the rebuilding of military stockpiles, all of it requires government spending that exceeds tax revenue. That gap gets financed by issuing debt. That debt eventually gets monetized by the Federal Reserve. That monetization increases the supply of dollars. Bitcoin has 21 million coins, total, forever. The supply of dollars is going up. The supply of Bitcoin cannot go up. That is not a conspiracy. That is arithmetic. Hayes told the market directly, the best time to buy Bitcoin will be after the Fed announces rate cuts. Wait for the signal, then move. He also recommended patience, as he is not calling for blind leverage right now. He's calling for structural understanding. And the structural understanding is this. Every major conflict the United States has fought in the last 40 years has ended with a weaker dollar. And a weaker dollar, historically, is good for scarce assets. But here's the question nobody is asking. While retail investors are panicking and selling, who is actually buying right now? Remember the question I left open in Chapter 1? I asked you, what happens when institutional traders go back to their desks on Monday morning after selling Bitcoin as an emergency ATM on Saturday? Here's what happened. On Monday, March 2nd, 2026, the first trading day after the airstrikes, US spot, Bitcoin ETFs recorded $458.2 million in net inflows. $458 million in a single day. BlackRock's IBIT fund alone brought in $263.2 million. 7 other funds, Fidelity, Grayscale, and others, recorded additional inflows. Let me be precise about what that means. BlackRock is the largest asset manager in the history of the world, managing over $10 trillion in assets. It has a legal fiduciary duty to act in the best interest of its clients, meaning it does not make emotional decisions or panic buy. When BlackRock put $263 million into Bitcoin ETFs on the Monday after a war started, that is a deliberate, calculated institutional signal that the price was attractive and the thesis was intact. While you were reading Bitcoin as a risk asset headlines, the largest asset manager in human history was quietly accumulating. That divergence between institutional behavior and retail narrative is the most important signal in this entire story. And it connects to something even bigger, because we are in a new era of Bitcoin market structure. An era that did not exist during the last major geopolitical crisis. In 2020, when COVID hit, there were no spot Bitcoin ETFs and no strategy with 700,000 Bitcoin on its balance sheet. There was no institutional infrastructure to absorb and deploy capital at institutional scale. Today, that infrastructure exists, and the presence of that infrastructure changes what happens after every market shock. In the old world, retail panic sold, and there was nobody's systematic buying. In the new world, retail panic sells, and BlackRock, Fidelity, and every institutional allocator with a Bitcoin ETF mandate systematically buys the dip. That is not a guarantee of price direction, as nothing in markets is guaranteed. But it is a structural change that fundamentally alters the risk profile of every Bitcoin drawdown going forward. Now I want to bring this entire conversation together: the Iranian capital flight, the Basel regulation, the Fed printing cycle, the institutional infrastructure, and give you the clearest summary of what is actually happening. I call this the 3-layer thesis, and I want to be transparent. Each layer has a real risk attached to it, as this is not a hype video but a framework. Layer 1, the geopolitical demand layer. Every time the United States weaponizes the dollar, through swift exclusions, asset seizures, sanctions regimes, it proves to every nation on earth that the traditional financial system is not neutral infrastructure. It is a geopolitical weapon. Iran learned this, Russia learned this, and now every country in the BRICS Plus bloc, including India, China, Brazil, and South Africa, is watching this conflict unfold and asking the same question. What do we use when they come for us? Bitcoin is the only answer that is genuinely politically neutral. No government issued it, no government controls it, and no sanction can freeze it if it's in self-custody. Risk to layer 1. Governments can crack down on exchanges, as regulators often tighten capital flow controls during wartime to prevent sanctions evasion. If the US decides that crypto is being used to fund Iranian proxies, which the IRGC data suggests is happening, regulatory pressure could intensify significantly and quickly. Layer 2, the monetary policy layer. The Federal Reserve has responded to every major Middle East conflict with monetary accommodation. The Gulf War, the global war on terror, the Iraq War. All of them ended with a weaker dollar and expanded money supply. War costs money, and that money eventually comes from the printing press, which devalues existing dollars. Bitcoin's supply is fixed. Risk to layer 2. The Fed does not pivot. Inflation stays elevated, and the central bank maintains its hawkish stance and refuses to cut rates regardless of military spending pressures. Hayes' entire thesis depends on a Fed pivot that, as of today, has not materialized, meaning timing is genuinely uncertain, and if the pivot takes 2 years instead of 2 months, you are holding through significant volatility. Layer 3, the institutional infrastructure layer. For the first time in Bitcoin's history, there is a regulated institutional-grade investment vehicle, the spot ETF, that systematically buys Bitcoin during drawdowns. BlackRock buying $263 million in a single day during a geopolitical crisis is not noise, it is signal. The Basel III reform discussion, if it results in reduced risk weights for Bitcoin, would unlock direct bank participation in a way that has never been possible before. That is a demand shock the market has never experienced. Risk to layer 3. Basel reform is slow, uncertain, and politically complicated, and even if the risk weight drops, it does not guarantee immediate bank adoption. Institutional behavior is governed by committees, compliance departments, and fiduciary frameworks that move slowly. Here is the honest summary. The structural forces, dollar weaponization, fixed supply, institutional infrastructure, historical Fed behavior during wars, all point in the same direction. But the timing is uncertain. The risks are real, and anyone who tells you they know exactly when this plays out is either lying or deluded. What I can tell you with confidence is this. The woman in Tehran who moved every rial she had into Bitcoin at 9:45 in the morning on February 28th, she wasn't making a speculative bet. She was making a survival decision. And the fact that 11 million people in one of the world's most financially isolated countries are making that same decision. Every time there is a crisis, every time there is a sanction, every time there is an internet blackout, tells you something about Bitcoin's role in the world that no price chart can fully capture. This is not just a financial asset anymore. This is infrastructure. Let me bring you back to the beginning. February 28th, 2026. A woman in Tehran, and 11 million people just like her, moved their savings into Bitcoin the moment the missiles hit. Iran's largest exchange saw a 700% outflow spike in minutes. Bitcoin dropped 4%, and the headlines called it a crash. And on Monday morning, while those headlines were still trending, BlackRock put $263 million into the Bitcoin ETF in a single trading session. The price is not the story. The mechanics are the story. The mining operation that produces Bitcoin for $1,320 and sells it at $67,000, that's the story. The banking regulation that forces $12.50 of capital reserves for every $1 of Bitcoin, and the reform movement that may change that forever, that's the story. The 40-year pattern of wars leading to money printing, leading to hard asset appreciation, that's the story. And the woman in Tehran, using a censorship-resistant digital asset to protect her family's savings from a collapsing currency and a failing banking system, that might be the most important story of all. Because Bitcoin was built exactly for this moment, not for the bull market, and not for the ETF flows, for the moment when everything else fails. The fact that you are still watching this video right now tells me everything I need to know about your focus. You are part of the tiny percentage of people who actually do the work to understand structural shifts. I want to know exactly who you are, so drop a comment below with the words, "Now I see the machine." That is our secret code to let me know you made it all the way to the very end of this video. Next week, I'm going to show you the exact moment in Bitcoin's history when institutional behavior shifted from speculation to accumulation. We will look at the on-chain data that proves it is happening right now. You are the exact kind of thinker this channel is built for, and I appreciate your time. Hit that subscribe button, leave a like, and I will see you in the next one.